Highly significant. The 35 level was like a really big resistance. We tried to break through there twice earlier this year and it failed. And as you said, it's like almost 14-year highs. And there are a lot of speculators and traders who use these momentum, these breaks of very long-term levels as a way to get into the market, and they push the market higher. I think it's called the turtle trading system, which was devised in the 80s by a hedge fund trader called Richard Dennis, and he looked at 22 and 55 day levels. If you broke new highs or new lows through 55 days, it was very bullish. But so here we are, we're breaking 14-year highs, so I think it's very bullish. It might sound a little bit exaggerated, but if you look back at history, silver has always been the money of the people. It has been taken away or demonetized since the mid to late 60s in most Western countries. But I think that if you look back at 1980 and 2011, you had two major crises there. The first one was the dollar crisis. Some people probably don't remember. I don't remember it, but I've read about it that in the late 70s, like 78 and 79, the U.S. Treasury issued what they called Carter bonds. They were U.S. Treasuries denominated in Swiss francs and Deutschmarks because no one wanted dollars. So yeah, in 1980, January 1980, yes, the Hunt brothers did try to corner the market eventually, and the regulators stepped in and stopped people from going long silver, and it stopped that speculative move in silver up to 50. But Paul Volcker was the chairman of the Federal Reserve, and I've read that he's commented after the event that there were some brokerage houses that were in trouble that could have gone under. It could have brought probably the whole banking system under, and eventually, he had to allow short-term rates to go to 20% a few months later, or back in 81, 10-year Treasury yields rose up to 15.5%. So yeah, I think silver was like the canary in the coal mine, so to speak. And in 2011 as well, when we almost touched 50, that was right at the beginning of the sovereign debt crisis in Europe, of the PIGS, which was an acronym for Portugal, Italy, Ireland, Greece, and Spain. And eventually, in the summer of 2012, Mario Draghi, the president of the ECB, he came out and said, we're going to do whatever it takes to save the euro and stop this sovereign debt crisis from spreading. And whatever it takes, of course, was money printing. It wasn't raising rates like Paul Volcker did in 1980, because nowadays, Elijah, there's so much debt in the system that you can't raise rates anymore to solve a crisis. You've got to cut and print more.
Silver has long been regarded as the people's money, a currency of the masses. Historically, it has been central to global economies, yet in the 1960s, most Western nations began demonetizing it, reducing its use in favor of fiat currencies. The most significant silver crises occurred in 1980 and 2011, each marking key moments in global financial history. In both cases, silver prices surged due to deep economic turmoil, showing the precious metal's role as a hedge against monetary instability.
Raising rates doesn't solve anything. They raised rates in the 80s to bring back investors into the dollar. They did that in 1992 here in the UK as well. When the pound collapsed, they raised rates to try to attract investors. They reversed those hikes very quickly, but nowadays the system is so leveraged that they have to keep. Well, they'll have to cut or print more, and what a move above. Towards 50 or even above 50 in silver, which I think is highly possible, would signal as a crisis. I don't know. We will find out. I think it will probably be afterwards, just like it was kind of in 1980 and in 2011, or it could be concurrent as well. And what could it be? Well, you were asking me about the Japanese government bond market. It could be that. Japanese long-term government bond yields have been spiking massively in the last 18 months. They've gone from being near zero and sometimes even negative, like in the 10-year, to now being 1.6 in the 10-year and above 3% in the 30 and 40-year. In Japan, the Japanese government debt to GDP is like 250%. And I've even read, Elijah, that rice prices in Japan, they've doubled in the last year. And that's like a staple of their diet. So the Japanese central bank, the BOJ, is really between a rock and a hard place because they can't really cut because their CPI is running like at 3.5–4%.
The late 1970s witnessed a severe crisis in the U.S. dollar, prompting the Treasury to issue Carter bonds in foreign currencies like Swiss francs and Deutschmarks. This was a response to the loss of confidence in the U.S. dollar. Fast forward to 1980, silver reached an all-time high, driven by the Hunt brothers' attempt to corner the market. Yet, the Federal Reserve's intervention under Paul Volcker halted the price surge, triggering a broader financial crisis. Volcker had to take drastic measures, raising interest rates to 20% to stabilize the system.
And if the Fed can lower the short-term rates, they can influence the short-term rates by lowering the Fed funds target, but it might actually make the longer end spike. And I think that's what Powell is concerned about because ever since the Fed cut rates back in September of 2024, September 2024. It's just that it was September 18th, and that's why I got confused. They cut rates by 50 basis points, and they cut again twice. The 10-year yield has gone from 3.6 to right now, as we speak here, we're at 4.42. So if anything, it could actually hurt the longer end. Investors might be spooked. And why is that? Well, I think, Elijah, it's because you've got the stock market at all-time highs. You've got a lot of commodities, gold and silver included, at all-time highs. The economy is not really in the recession, even though it's slowed down. It's still doing well. Wall Street is ticking along. So to cut rates right now would be like, throwing more gasoline or, petrol into the fire. And coupled with the debt situation and the deficit, that wouldn't help. That wouldn't help the finances, and it would probably drive actually the U.S. into a recession.
In 2011, silver prices soared again, nearing the $50 mark, reflecting mounting fears about the Eurozone's sovereign debt crisis. This time, it was the economies of Portugal, Italy, Ireland, Greece, and Spain, the PIGS, that were in jeopardy. As silver surged, European leaders were forced to act. Mario Draghi, president of the European Central Bank, famously declared that they would do whatever it takes to preserve the euro. This involved massive money printing, an approach starkly different from the rate hikes seen in the 1980s, showcasing how the global financial system had evolved.
Highly significant. The 35 level was like a really big resistance. We tried to break through there twice earlier this year and it failed. And as you said, it's like almost 14-year highs. And there are a lot of speculators and traders who use these momentum, these breaks of very long-term levels as a way to get into the market, and they push the market higher. I think it's called the turtle trading system, which was devised in the 80s by a hedge fund trader called Richard Dennis. And he looked at 22 and 55 day levels. If you broke new highs or new lows through 55 days, it was very bullish. But so here we are, we're breaking 14-year highs. So I think it's very bullish.
Today, the tools available to central banks have changed dramatically. With unprecedented levels of global debt, rate hikes no longer offer a viable solution to economic distress. In fact, raising rates could destabilize markets even further. Unlike in 1980, when the Fed's aggressive tightening helped to restore confidence in the dollar, today's system requires constant monetary expansion to keep afloat. Silver, again, stands poised to act as an early warning signal, just as it did in the past during moments of extreme monetary crisis.
We reached $39 and change earlier this week. It's come back off, mainly because I think the bullion banks, the swap dealers, if you want to call them, they're short quite a bit, and they're trying to fight the market. But I think we're going to continue to see the market move higher. They're kind of under control right now. But I saw, Elijah, that SLV ETF a few days ago, and it was Bob Coleman who posted this on X. Apparently, the bullion banks are unable or were at a certain day not to borrow the shares to go short. So things are very tight, and a lot of physical silver is being drained from the London Bullion Market Association, or LBMA. We are at very long-term lows in terms of inventory. I think it's only 155 million troy ounces. So yeah, the technical picture looks good. I think the next target could be in the mid-40s, and we could see that quite soon, I think. So the other thing is that silver seems to be now outperforming gold slightly, and that's always positive, not just for silver, but even for gold going forward.
In recent years, silver has begun to outperform gold, signaling increasing investor interest. As silver nears $40 per ounce, technical indicators suggest that its rally is just getting started. However, there are challenges. The market remains highly influenced by paper silver trading, with entities like COMEX and LBMA creating artificial market conditions through derivatives. These paper markets often suppress the true value of silver, but as physical shortages emerge, the price could break free, leading to a new bull run. Traders are already watching for the mid-$40 as the next target.
That's right, and I think the above-ground inventory, you're making, excuse me, it's more profitable right now to scrap silver because the price has gone up, but I still think it's not really that great. So that's going to push things even higher because, the deficits that the market has been running in silver, that will be negated in years, not in months, because there's not too many primary silver producers, and to start producing silver takes time. You as a silver mining explorer, it takes years to drill for the silver, and then to get all the permits and everything, and then you've got the political risks, like in Mexico. Mexico is a big producer of silver. I saw recently that their government are not going to issue new licenses for I think it's open pit mining, or it could, so The other thing, it takes a few years after you drill for the silver. You got to build the plant and then start processing. Taking it out of the ground. It takes 3, 4, 5 years. So yeah, the prospects, fundamentals are still good, supply and demand for silver. And on the other hand, I think silver has been capped down through the infinite amount of paper that the COMEX and LBMA create via their, it's called, I think Eric Young called it the COMEX LBMA exchange for the physical doom loop, and I think that's coming under pressure. So that will drive the price higher as well, because they're not really trading real physical silver there. They're trading paper, and eventually when people really need the physical, they're going to have to cover their shorts.
The supply-demand dynamics of silver are set to remain favorable. Despite high prices, silver production has not kept up with growing demand, especially in industrial uses and investment. Adding to the pressure, key silver producers like Mexico are tightening their mining regulations, further constraining supply. The limited number of primary silver mines and long lead times to bring new projects online means that silver's scarcity will likely intensify. This creates a bullish outlook as the silver market faces a deficit that could push prices even higher in the years to come.
It looks like the silver market has got a lot more depth in the past. I think it was last week they did that. It would have driven the market lower, and it would have stayed there for maybe days or weeks, and it was only a matter of an hour. The market came right back, and I worked as a futures and options broker for government bonds. I did trade a bit of commodities, gold and silver as well, but if I got an order from a client, a big order, the client usually used to tell me, please, I'll leave you the order and you work it because it's a big order. So I would sell a little bit every 10 minutes or so. I wouldn't go into the market and just dump everything because I'm trying to get the best price. So yeah, I agree. You see a lot of that, unfortunately, and I've been seeing that for over 20 years in gold and silver futures, because even though I didn't trade the futures in gold and silver that much, I kept an eye on it, and I would see these smashes, and yeah, it seems like now it's not happening as much.